Hello and welcome to today's video. Today we're going to be looking at some tips and some guidance to help you be successful with your diploma in international financial reporting. My name is Jayne Howson and I've been helping students prepare for ACCA exams for a number of years. In this session we're going to be talking about deferred tax. Now I need to stress that I'm not here today to reteach everything there is to know about deferred tax. My main point is to try and make sure that we discuss some aspects that the examiner has highlighted in their comments on issues which students have not been scoring very well on. Now, we know that deferred tax is not a tax subject, and I do not expect you to know anything about any particular nationality's tax regime at all. What we're doing here is we're being the bookkeeper and we are recording transactions. Now, what we're going to be looking at today in particular, as I said before, were areas where the examiner has said students haven't been scoring very well. And there are basically one main element, which is the discursive element of deferred tax. We all know that this comes under IAS 12 on taxes. And the examiner has highlighted that when preparing consolidated financial statements in question 1, students have been scoring really well on the calculations for deferred tax on both fair value adjustments and unrealised profit adjustments. But where students are not scoring too well are in questions 2 and question 3, where you are given perhaps some transactions and you're asked to explain to somebody how these are accounted for. And the examiner has said that students are falling into the trap of just giving calculations and giving a list of journal entries, and that is not explaining. Remember, what we're trying to do at this level is to communicate. Somebody comes to you and says, I don't know how to account for this transaction. You are not going to simply give them a list of journal entries and go, there you go, that's what you need to do. You're going to talk them through and you're going to explain the principles and you're going to apply them to the scenario. And that's exactly what we're going to do here in our examination. So in questions 2 and 3, you are going to look for what the examiner is asking you to do. And I'm going to talk to you about some of the discursive aspects that tend to come up. The first point is where we're going to be talking about definitions. And sometimes, particularly in question 3, more than question 2, the examiner might ask you what a tax base is or what a taxable temporary difference is. And students are not good at preparing those answers. Also, it's the explaining the accounting treatment. There's nothing wrong with giving journals as long as you explain why you're giving them and what those journals are doing. So let's talk about some of these basic points that we need to highlight. Now, to emphasize the point here, I want to explain what the syllabus actually says about deferred tax. And the first point in the syllabus is about outlining the principles of deferred tax. Now, outlining the principles is not calculating necessarily. It is asking you to be able to communicate. In addition, the examiner is expecting you to explain the effect of taxable and deductible differences. But what does that mean? Well, explaining the effect means talking about what it does to the financial statements. And what the examiner is looking for here is getting you, yes, to calculate what those are, but then telling everybody whether this is going to be an asset, a liability, an expense, or income. You do need to think of both sides of the double entry. And yes, picturing journal entries in your head can be quite useful for that. But you need to state in words that, yes, I'm going to be debiting an expense, but it is a tax expense and it's going to go into the statement of profit or loss. And yes, I am crediting a liability and it's a long-term, non-current liability and it's going to be shown in the statement of financial position. So explaining the effect is quantifying, doing the numbers, and telling the examiner where it goes. Now, before we start, let's just have a little look before we start getting into some detail for these reasons why the examiner says students are losing marks. They're not reading the question. When it says explain or discuss, you need to explain what the transaction is doing and where it goes. If the question says define, that's a knowledge-based requirement. You simply define the points that you've been asked to define. If they say calculate, then you do some numbers. Now remember, in question one will always say to you to prepare a consolidated statement of financial position or a consolidated statement of profit or loss. And specifically, the examiner will say, please don't give me any explanations. In that case, you are simply calculating. But in questions 2 and question 3, where you're being asked to discuss and explain, potentially define, that's exactly what you should be doing. As I mentioned before, the examiner has said students simply give a list of journals and don't explain what those journals are doing. Remember, journals do not tell the examiner where the transaction goes specifically. It will tell them where the debit or credit is to be recorded, but it doesn't explain where that provision itself or that expense itself is recorded in the financial statements. And as I keep saying to you, the examiner says there's just not enough words in here. So we need some full sentences. We need you to read the question. Yes, by all means, calculate if that helps, but you should also make sure that you are explaining to somebody, pretend that you're talking to somebody who's more junior to you. Now, there are some things that we do need to learn, and you have these in your learning materials, but I just want to point out some words that you do need to know the definitions of before you go into the exam room itself. The first one that we're going to look at is the word tax base. Now, if you want tax base, the examiner has asked in the past about defining the tax base of an asset and defining the tax base of a liability. Don't expect you to get it word perfect from IAS 12, but you do need to learn what these are. So we know, for example, that a tax base of an asset is the amount that will be deductible for tax purposes against any taxable economic benefits that will flow to an entity when it recovers the carrying amount of the asset. In simple terms, imagine the taxman is preparing a statement of financial position. What would be the value of the asset in that statement of financial position? This could be a non-current asset, which will be the cost less any tax depreciation to date, or it could be some form of receivable. Tax base of a liability is its carrying amount less any amount that will be deductible for tax purposes in future periods. Now, when we're looking at the tax base of a liability, imagine that the examiner is preparing, the taxman is preparing a statement of financial position, and in that statement of financial position, they are preparing their liabilities, amounts that are owed. Now, next thing that you need to be able to define is looking at a taxable temporary difference. Now, a taxable temporary difference, sometimes abbreviated to a TTD, and that's fine to abbreviate that if you want to. Be very clear that this is going to be where the carrying amount of any asset exceeds the tax base, or it could be the other way round for a liability. But be clear in your answers that it is the carrying amount versus the tax base, and use the word exceed when you're talking about an asset. Equally, if we are looking at a deductible temporary difference, you're going to state very clearly that when we're looking at this for an asset, this is where the tax base exceeds the carrying amount. Now, what you also need to make clear when you're explaining these definitions is that a taxable temporary difference is going to give rise to a deferred tax liability, and a deductible temporary difference is going to give rise to a deferred tax asset. Remember that you can net these off if we are talking about both amounts being potentially relating to the same tax jurisdiction. Now, what principles and accounting treatment do we need to know, and what do we need to learn? Well, when we're looking at explaining something, discussing, describing, the first thing that we're going to do in any exam answer is to show how to calculate the tax base. Yes, you're going to give the numbers in that, but you explain, I've calculated this tax base by taking the cost of the non-current asset and I've deducted the tax depreciation to date. You will then explain that this will be compared to the carrying amount. You might even then explain that the carrying amount is the amount that is shown in the statement of financial position. You would then explain that you would deduct the tax base and the carrying amount to create a temporary difference and state very clearly whether this is taxable or deductible. That's really important. And explain why. Because the carrying amount is bigger than the tax base, it's a taxable temporary difference. Because the carrying amount is smaller than the tax base, it's a deductible temporary difference. Then you're going to explain that that temporary difference today is going to give you the provision for deferred tax that's going to be recorded on the statement of financial position. And you're going to tell the examiner that that provision is going to be a non-current liability. If it is a liability, it could potentially be an asset as well. But let's assume it's going to be a liability. You state it's a non-current liability on the statement of financial position. That is very specific and it explains where it's recorded. You then also describe the fact that you look at the difference between the opening and closing provision, and the movement in that provision, state whether it is increasing or decreasing, will be shown as an expense or income in the statement of profit or loss. And explain where that is recorded. So we're saying it's an increase in provision, it creates an expense, a tax expense in the statement of profit or loss. You're telling them whether it's deducted or added, you're telling them where it goes. Now, this might seem really obvious, and if I was preparing a statement of journals, a list of journals, this is exactly what I would be doing. I'm just trying to add some words in here to make it clear that I understand what's going on. Now, to try and explain this in a little bit more detail, let's have a look at an illustration. This is not necessarily one that the examiner has set, it's one that is just a general, typical exam standard question. And I'm going to give you a couple of seconds to have a read through. Now, having read through, first thing that we're going to do is we're going to define the tax base of an asset as outlined in IAS 12. That is the first requirement that we're looking at here. The word define is a knowledge dump. So what you're doing is being very clear on precisely what the tax base is, and it says of an asset. So don't start telling the examiner about the tax base generally or the tax base of a liability. Use your definition to explain the tax base and the deferred tax of a machine purchased in the year. So here we're given the cost of this machine. We're given the depreciation charge, and from that we can calculate the carrying amount at the year end. We're also given information about a deduction of what effectively is going to be tax depreciation against any taxable profits. So we have enough information in here to work out a tax base. We're also explaining in here that the remaining cost will be deductible in future periods, either as depreciation or as a deduction on disposal. The examiner is helping you here create this idea of a tax base. and also giving you the tax rate. So, reading the question, there are two things that we need to do down here. We're going to, number one, define, and number two, we are going to explain. We're going to use our definition to explain points. Now, because we've been given some numbers, we're going to use those numbers to calculate the deferred tax. And then what we're going to do is we're going to tell the examiner exactly where these numbers go. So, on this first answer, what we've got down here is the definition of a tax base of an asset. It's a sentence. It's not going to be worth very many marks, but I'm being very precise. If I don't use the exact words that are in the standard, that doesn't matter as long as I've got the general gist of it. So the tax base of an asset is the amount which will be deductible for tax purposes against any taxable economic benefits which will flow to the entity when it recovers the carrying amount of the asset. You can learn that. You can then include that as part of your answer. Then what we want to do is to use this definition, in other words, demonstrate to the examiner that I know what the tax base is, and what I'm going to do is to calculate what the deferred tax is going to be, and I'm going to explain how this is accounted for. Now, notice down here, I've put these in sentences. I've not done journals. If you want to do some journals as a little working to the side to help you sort of then talk through them, absolutely fine. But I've tried to put these in full sentences. So where an asset is purchased for $250,000 and has already received a tax deduction, then the future tax deduction which is available will be $150,000. This is using my definition of a tax base to explain that if I take the cost less the tax depreciation, I get the tax base. And my next sentence is, therefore the tax base is $150,000. I know that I need to compare that to the carrying amount. The carrying amount is $250,000 cost, and I'm going to deduct the $50,000 depreciation. I'm stating very clearly where the numbers come from and the fact that it is a $200,000 carrying amount. Then I'm comparing the two. And you can do this in several sentences. I've tried to do this in one sentence, but the tax base is smaller than the carrying amount. This creates a taxable temporary difference of $50,000. I've stated it's a taxable temporary difference. I've stated why by explaining the tax base is smaller than the carrying amount, and I've explained the amount. Then what I'm going to do is to explain where the provision comes from. By applying the tax rate of 20% to that difference, I am going to arrive at the carrying amount of the deferred tax provision. So I've explained the tax rate is applied to the difference. It creates the carrying amount of the deferred tax provision. And I've said how much it is. This is 20% of $50,000, which is $10,000. Then I've explained that the provision is recorded as a non-current liability in the statement of financial position. I've said it's gone into the statement of financial position, and I've explained where it's gone in the statement of financial position. I've then tried to explain how the deferred tax is arrived at in the statement of profit or loss. The increase in the provision, if I started with nothing at the beginning of the year and I had 10,000 at the end, it's an increase, is a tax expense in the statement of profit or loss. Again, I've given the amount, I've said where it goes in the statement of profit or loss, and specifically in the statement of profit or loss that it is a tax expense. Now, I don't need you to write a lot. We need to be very specific. We need to use the calculations and quantify our comments. But remember, you're trying to explain to somebody what they should be doing with these numbers that you've calculated. And a list of journals is not going to be enough. Now, I hope you found that helpful. I've certainly enjoyed talking to you today, and I wish you the very best of luck with your DipIFR exam.